Well, markets are sharply lower today amid worries of a prolonged conflict in the Middle East. But how should investors be approaching asset allocation with all this uncertainty? Joining us now to discuss is Christian Medeiros, Vice President and Portfolio Manager for Asset Allocation with TD Asset Management. Chris, welcome back to the show once again. Given all this volatility, we're glad to have you on the show.
Thanks, Anthony.
All right, so from an investing standpoint, investing lens, what are the potential scenarios that might play out in the Middle East given all this volatility?
Yeah, I think it'd be helpful to think through three main scenarios. The first scenario would be a fairly quick de-escalation, where we'd see ceasefire, negotiation, and a seizure of hostilities within the region. That would result in risk premiums falling, energy markets being more tame, and a return to strong fundamentals within markets. The second scenario, which would be more negative, would be a prolonged escalatory period where hostilities continue for not just days, but weeks, and where threats from Iranian strikes, whether it be drones or missiles on the Gulf, results in prolonged disruptions, which would result in higher insurance premiums and disruptions to the energy market there, which constitutes 20% of global throughput for oil markets. And that would then have knock-on effects to inflation and the path for policy globally. The third scenario would be instability within Iran that could lead to a whole range of different outcomes, including regional destability and rising geopolitical risk premiums for some time.
All right, so given that outlook, I know that you gave us those three scenarios. How could that impact the broader economic and macroeconomic environment for markets?
Yeah, so I think it's important when we see a geopolitical headline to think beyond the headline and think through how that transmits to the key macro drivers of growth, inflation, and policy. So when we think about this conflict, why it matters is because we're previously in a period where we're seeing improving growth globally and relatively tame inflation. However, if we are seeing higher energy prices, which will flow through to higher inflation, that could slightly change the macro regime to one that's a bit more inflationary, and that would have a lot of asset allocation implications. And that would be because higher inflation would mean potentially less cuts for central banks, especially in the United States. It might be a higher bar for them to cut as much as the market expects. And beyond that, energy is a tax on the global economy, and so that could actually have an impact on global growth as well. So what we're really focused on is how the energy crisis, if it were to persist, how that would flow through into macro dynamics and how that would change your asset allocation.
Now, obviously, the narrative has changed today. It's from the start of the year. Are the themes that pushed the markets higher early in the year, are those still intact?
What we're seeing earlier in the year, and I think it's still intact, was an industrial recovery globally, especially in the U.S., strong earnings growth within the U.S., and very strong capital investment as well, even beyond just the semiconductor investment that we've seen. So the growth dynamics have been quite strong. This doesn't change any of that in the near term. However, what we need to be wary of is that transmission mechanism from energy to inflation and energy to any impacts on consumer or growth. So that's what we'll be watching for. But that doesn't, in the short term, change anything on the growth dynamics that we're seeing, which were quite positive in the first 2 months of the year.
Okay, so given that backdrop, how should investors approach asset allocation with this uncertainty backdrop?
Yeah, I think when you're approaching asset allocation, you shouldn't be reacting to headlines. You should be building portfolios that prepare you for a whole range of outcomes, preparing you for different regimes. So what we've been focused on in our construction for some time is in a regime where we have high and rising inflation, like we've seen in past crises, like in 2022, you need other asset classes beyond just equity and fixed income. So we've diversified our exposures by adding direct commodity allocations, by adding infrastructure and real estate that also do well and can keep up in inflationary environments, and also making sure we have regional diversification because different countries and currencies are affected differently by rising inflation. So putting that all together, it's to build a more resilient portfolio because we think asset allocation is not about predicting what comes next, but being able to survive and thrive in all regimes that could take place.